Hey there, awesome accounting student. Mark Franke here. This is chapter 1 for Accounting 101, and we will go through the basics of how the accounting process works, and we'll then do the problem 1-2b. So let's get started. The accounting equation that was designed by the Italian monk back in 14th century, 15th century, is there on the screen. Assets equals liabilities plus equity. The actual algebraic formula is assets minus liabilities equals equity, but it's hard to deal with this minus thing, so we, in effect, using algebra, we move the liabilities over to the other side of the equal sign to make it positive. So we're really talking about two things. Assets, things that you own that have value. They are future value, right? So if you've already used something, that's an expense. It doesn't have value. If you're going to use it in the future, it has value, and that's an asset. That's, in effect, the difference between an asset and an expense. Assets are things we're going to use in the future. Expenses are things we've already used. So liabilities is money that you owe for things you've gotten the benefit for in the past, whether it's a vendor that sold you some goods that you have to pay for, or employees that have worked for you that you owe them their wages, or a liability could be money that we borrow from the bank that we agree and promise to pay back in the future. So when we take these two things, assets and liabilities, and put them into the equation, equity is the balancing figure. So we don't really have a definition for equity other than the difference between assets and liabilities. That is the definition of equity. If you own an apartment building in Bellflower worth $1 million and you have a mortgage on that apartment building that's $600,000, your equity in that building is $400,000, but you can't show somebody your equity. You can show them the asset and say, here's my asset, it's this apartment building in Bellflower, or you can show them a mortgage statement that says I owe $600,000 on it. So that's really the way equity works. Now, equity has 4 components. 2 things relate to the owner and 2 things that relate to the operations. In this course, we're going to focus on corporations, but from Accounting 100, we focused on sole proprietorships. The difference, the accounting equation works exactly the same, whether it's a sole proprietorship or a corporation, but the corporation just uses a little bit different terminology. So in a sole proprietorship, we use capital, and in a corporation, we use capital stock or common stock. We'll get into that later chapters. In a sole proprietorship, when the owner takes money out of the business from the profits, that's called a drawing or a withdrawal. When a corporation takes money out in the form of profits, it's called a dividend. On the other side of the coin is the operations. So those are the owner's things, and then the operations is exactly the same, revenue and expenses. So these 4 things are how we categorize what happens in the assets and liabilities as we record transactions. So I provided you with a handout that looks like this. For problem 1-2b, first thing I will do is put my name at the top. And we'll go through the calculations here to see how the accounting equation works. And this should be totally reviewed. This is the same thing that you did in your accounting 100 class. So we have 5 companies here, V, W, X, Y, Z. We'll start with V. So the first thing that we have to do is we have to figure out what the equity is at the beginning of the year. We're talking about 2 years here, 2018, 2019. The beginning equity in 2018 was $29,000. The ending equity, and I'm just getting that by subtracting liabilities from assets, so is $23,000. So our equity went down by $6,000. So what we can do now is, by figuring out that change in equity, and we know it's $6,000, so I'm going to go ahead and plug that in. We know that the change in equity was a negative $6,000. So we know that stock issuances, or common stock or capital, makes equity go up, and cash dividends make equity go down. That means that if you take those two things together, that's a negative 500, which means that the net loss in this case had to be a negative 55. That's in the wrong place, sorry. Had to be a negative $5,500 in order for this to work. So we can plug in the net loss as $5,500. By the way, I provided the handout with this video in Canvas, so you can follow along and plug these numbers in as we go and use this for doing problem 2A. Let's move on. First thing I want to do is calculate equity at the beginning of the year. This is for company W, but in this case, they've given us what is the stock issuances, the net income, and the cash dividends. So if we summarize those 3 things, we get the change in equity of $58,000. What we're trying to find out is what ending liabilities is. So if the change in equity was $58,000 and beginning equity was $20,000, that means that equity at the end, because it went up $58,000, has to be $78,000. And I've got that by adding together the $20,000 and the $58,000. In other words, beginning equity was $20,000, ending equity was $58,000, so it had to have gone up to $78,000. And now we can figure out what liabilities is by subtracting equity from assets. And that means that the beginning liabilities, the ending liabilities is $22,000. It's like a puzzle, all the pieces have to fit together. For company X, beginning equity is assets minus liabilities, that's $73,000. Ending equity, $186,500 minus $65,800, which means that equity went up $47,700. So that means down here, the change in equity has to be reconciled or explained by these 3 components: stock issuances or capital, net income, and cash dividends. They told us that the net income was $18,500. They also told us that there was no cash dividends, so that means that the change in that capital or stock issuances had to be the change in equity minus net income, which is $29,200. I'm going to go ahead and make are the answers that I need. Yellow, so they're obvious. 29,200. Okay, so here's what I'm going to suggest. Pause the video, see if you can figure out what assets at the end of the year were for company Y. That's this box. And liabilities at the beginning of the year for company Z. You can stop the video and I will put this information in, and then you can start it again and see the answers and check. Okay, did you get 135,100 as the ending assets in company Y? And did you get 100,000 as the beginning liabilities for company Z? If not, try it again. Make sure you understand how these components work, and then move on to problem 1-2A, which has the same exact concepts but different numbers. All right, that's all for now. I'll see you again soon.